The stock market can seem like a complex and intimidating world, especially for newcomers. The sheer volume of information, the fast-paced nature of trading, and the potential risks involved can be overwhelming. However, it's a world filled with opportunity, offering the potential for significant financial growth. With the right knowledge and strategies, you can navigate this environment and uncover opportunities that align with your financial goals. Like any new endeavor, understanding the basics is crucial. Grasping fundamental concepts such as market trends, stock valuation, and risk management can set the foundation for your investment journey. This guide will equip you with the foundational knowledge to begin your investment journey with confidence. By learning the essentials, you'll be better prepared to make informed decisions and avoid common pitfalls. Investing in the stock market allows you to become a part owner of companies you believe in. This means you can support businesses that align with your values and benefit from their success. As these companies grow and prosper, so too can your investments. The value of your shares can increase, leading to potential capital gains and dividends. Whether you're aiming for long-term financial security or seeking to grow your wealth, the stock market provides a powerful avenue to achieve your goals. Consistent investing over time can help you build a robust portfolio. Let's dive in and explore the fundamental concepts that will empower you to make informed investment decisions. From understanding market indicators to analyzing financial statements, this journey will arm you with the tools needed to succeed in the stock market. Before you start investing, it's essential to understand the basic building blocks of the stock market. The stock market can seem like a complex and intimidating place, but breaking it down into simpler terms can make it more approachable. A stock represents a share of ownership in a publicly traded company. This means that when you own a stock, you own a small part of that company and have a claim on a portion of its assets and earnings. When you buy a stock, you're buying a small piece of that company. This ownership stake can increase in value if the company performs well, or decrease if the company faces challenges. These stocks are traded on stock exchanges such as the New York Stock Exchange or the Nasdaq. These exchanges provide a platform for buyers and sellers to come together and trade stocks in a regulated and organized manner. Think of these exchanges as marketplaces where buyers and sellers come together to trade stocks. Just like any other marketplace, prices are determined by supply and demand. Companies first enter the stock market through an initial public offering, or IPO. This is a significant event for a company as it transitions from being privately held to publicly traded. An IPO is the process by which a private company offers shares of its stock to the public for the first time. This event often generates a lot of excitement and media attention. This allows the company to raise capital for growth and expansion. The funds raised can be used for various purposes, such as developing new products, entering new markets, or paying off debt. Understanding these fundamental concepts will provide you with a solid foundation as you delve deeper into the world of investing. By grasping the basics, you'll be better equipped to make informed decisions and navigate the complexities of the stock market with confidence. When it comes to investing, there are various strategies you can employ, each with its own level of risk and potential return. Understanding these strategies is key to making informed decisions that align with your financial objectives. Seeking out undervalued companies with strong fundamentals requires a keen eye for detail and a deep understanding of financial statements and market conditions. By identifying companies that are trading below their intrinsic value, investors can potentially reap significant rewards when the market corrects itself. Focusing on companies with high growth potential, even if their current valuations seem high, is often associated with tech startups and innovative industries where rapid expansion is expected. Investors in this category are willing to pay a premium today for the promise of substantial returns in the future. Prioritizing investments that generate regular income, such as dividend-paying stocks, is particularly appealing to retirees or those seeking a steady cash flow. By focusing on companies with a history of consistent dividend payments, investors can create a reliable income stream. It's crucial to choose an investment strategy that aligns with your financial goals, risk tolerance, and time horizon. Your personal circumstances and financial objectives should guide your investment choices. If you're investing for retirement, for example, you have a longer time horizon and can afford to take on more risk. This allows you to potentially benefit from the higher returns associated with riskier investments, as you have more time to recover from any market downturns. Conversely, if you're saving for a down payment on a house in the near future, you'll need a more conservative approach. This means focusing on low-risk investments that preserve your capital while still offering some growth potential. By carefully considering your investment strategy, you can better navigate the complexities of the financial markets and work towards achieving your financial goals. Diversification is a fundamental principle of risk management in investing. It involves spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce the impact of any single investment performing poorly. The old adage, "Don't put all your eggs in one basket," rings especially true in the world of investing. By diversifying your portfolio, you're essentially hedging your bets. If one sector or company experiences a downturn, the impact on your overall portfolio will be minimized by the performance of your other investments. Diversification is a key strategy for mitigating risk and protecting your investments over the long term. Stock analysis is the process of evaluating a company's financial health and prospects to determine whether its stock is a good investment. There are two primary approaches to stock analysis: fundamental analysis and technical analysis. Fundamental analysis focuses on a company's financial statements, management team, and industry trends to assess its intrinsic value. Technical analysis, on the other hand, examines historical stock price movements and trading volume to identify patterns and predict future price trends. Both approaches have their merits and drawbacks, and many investors use a combination of both to make informed investment decisions. Understanding the basics of stock analysis will empower you to research companies and evaluate their potential as investments. To buy and sell stocks, you'll need to open a brokerage account. A brokerage account is essentially an account that allows you to trade securities such as stocks, bonds, and mutual funds. There are numerous brokerage firms available, each offering different features, fees, and investment options. When choosing a brokerage, consider factors such as trading commissions, account minimums, research tools, and customer support. Some brokerages cater to active traders, while others are more suitable for long-term investors. Take the time to research and compare different brokerages to find one that aligns with your investment style and needs. While it's tempting to try and time the market, aiming to buy low and sell high, history has shown that a long-term investment approach tends to be more successful. The stock market is inherently volatile, with short-term fluctuations driven by news events, economic data, and investor sentiment. By investing for the long term, you can ride out these short-term fluctuations and benefit from the overall upward trajectory of the market. Remember that time is your ally when it comes to investing. The earlier you start, the more time your investments have to grow and compound. Investing in the stock market always involves some level of risk. Stock prices can go down as well as up, and there's always the possibility of losing money. However, there are steps you can take to manage risk and protect your investments. One important risk management strategy is diversification, which we discussed earlier. Another is to invest only what you can afford to lose. Avoid investing money you'll need in the near future, as unexpected market downturns could leave you in a difficult financial position. Investing isn't just about numbers and financial analysis, it's also about psychology. Your emotions can play a significant role in your investment decisions, often leading to irrational behavior. For example, fear and panic can cause investors to sell during market downturns, while greed and euphoria can lead to buying at inflated prices. It's essential to be aware of these emotional biases and develop strategies to mitigate their impact on your investment decisions. Having a well-defined investment plan, Sticking to your long-term goals and seeking advice from a financial advisor can help you stay disciplined and make rational investment choices. The world of finance is constantly evolving, with new technologies and investment opportunities emerging all the time. From online trading platforms to robo-advisors, technology has made investing more accessible and convenient than ever before. As you embark on your investment journey, stay informed about these advancements and be open to exploring new investment avenues. The future of finance is filled with exciting possibilities, and by embracing innovation, you can position yourself for continued financial success.